Yo, what's up, you guys? Welcome back to another video. Today's video, we're going to talk about the CPI data that just got released, what it means, what it do, and how it's going to impact the market. If you are new here, a sub would be appreciated as I provide valuable educational content on a daily basis. If you do enjoy the content, please do consider smashing that thumbs up button there as well. Now, the first thing that we can obviously see over here is that the CPI data got released today. The first thing that we see there is CPI M/M. That means CPI month over month, and this means year over year. Now, the CPI is an indicator that is used by investors to measure inflation. The CPI is also an indicator that tracks the consumer spending. It also measures the average price that goods increase over a period of time, like for instance bread, or they call it a basket of goods and services. It measures the average price that it increases month over month. Now obviously when food prices becomes expensive, you know that you're heading towards an inflation. And something we saw last year with the Federal Reserve is that when the CPI was sitting at 9.2%, that means that inflation was very high, and the job for the Feds was to bring down the inflation. Now, how do they do that? It's basically through discourage consumers to spend more. And how this happens is by hiking interest rates. Now that you understand what the CPI means, or get an idea of what it does, how does this impact the market? Now, basically how this works is when you have a high CPI reading, that means the Feds need to bring this CPI reading down once again. We're going to call CPI inflation. So when the inflation reading comes through higher, the CPI is an inflation reading. The Fed's job is to make sure they keep inflation below 2%, right? The Fed need to make sure, and the only tool that they have at their disposal is to hike interest rates. The only way for the Feds to bring inflation down is to do what? Is to hike interest rates. And what does hiking interest rates do? It increases the value of the currency, which in this case is the dollar index. Now, anything that trades against the index, like a precious metal such as gold, they are negatively correlated. So when the Feds hike interest rates, that means, or when the CPI goes up, that means inflation goes up. That means the Feds are more likely to hike the interest rates, and this means we can expect the dollar index to increase in value, and currencies such as Euro USD, AUD USD, anything that trades against the dollar, anything that's correlated to the dollar like gold, we can expect these these metals to decrease in value. So to give you an example very quickly, okay, when the CPI goes up, that means inflation's going up. That basically means that we can expect the Feds to hike the interest rates. And once the Feds hike the interest rates, we can expect the price of the dollar index to increase. The reason why the Feds are hiking the interest rates is basically to bring the consumer spending index lower. And this means that when they bring the inflation lower, or when inflation comes lower, they are able to adjust the interest rate in line with inflation. But right now interest rates are running away with inflation. So what you have over here is you've got a ripple effect of so you've got the CPI, you've got the interest rates, and then you've got the dollar index. Now anything else, stocks, Euro USD, precious metals like gold and silver, they will then basically drop in value. Now that is the one way the market can go. Now, if you look at it the other way, if the consumer spending index comes down, which is basically what we saw over here, we saw this massive dip in the index. That was because the Feds started hiking interest rates last year, and this brought the inflation down, and we saw the market started to move to the downside. Now, let's take this whole thing, drop it on the head very quickly. Let's assume inflation is coming down, right? Now, just because inflation is coming down, that doesn't mean the Feds are going to hike the interest rates lower as well. Remember, the Feds got a job. They've got a target that they need to reach. So if inflation comes down by, let's say it comes down by 1%, that doesn't mean that the Feds now automatically is going to bring down is now also going to bring down the interest rates. No, they will either keep the interest rates as is, not change it, or they will still increase it but lower because of a target that they still need to reach. So this doesn't always mean that the interest rates are going to come down, but it does mean that you can expect the interest rates to go up slightly lower, or it can basically stay where it is. Now, in a situation like this, normally the dollar will lose value, or the dollar will basically start to decline very slow until something else comes out to move the dollar higher again. Now, the only way you'll see a massive dip in the price of the dollar index is basically when inflation is in line with the interest rate, basically where the Feds are able to lower the interest rate, because they now see that if they continue to lower the interest rate at the rate at which inflation is coming down, then we could potentially see the Fed not hiking the interest rates, and through that the dollar index will then become weaker. So just because inflation is coming down, it doesn't mean the Feds are going to hike the interest rates. It just means that the Feds need to basically maintain it. They have to water it the same way to make sure they bring down the inflation. Now, those are the two ways that you have to look through inflation. Now, remember all of this on the one side, right? This is good for the dollar index, and this basically means that you can expect the price of the dollar index to increase in value. And if this happens, that means you can expect the price of the dollar to slowly decrease in value, or it could potentially still go up, depending on where inflation is versus the interest rate hikes there as well. So now that we've got that out of the way, let's go over this article over here from FX Street. It says here, breaking news, the US CPI inflation has gone up to 3.2% versus the 3.3% expected by the Dow Jones, but it's still higher than what it was the previous year. It's still higher in terms of what it was the previous month there as well. It says the inflation in the US is measured by change in the consumer price index. CPI rose to 3.2% year over year, like I said now, and then in July from 3% in June. The US Bureau of Labor Statistics, or the BLS, reported in Thursday the reading came in slightly below the market's expectations of 3.3. Further details of publication revealed that the core CPI inflation, which excludes volatile food and energy prices, also came through lower to 4.7 from 4.8 on a monthly basis. The CPI and the core CPI both went up, both rose 0.2%, matching analyst estimates. Now, you can obviously see how the market reacted to it. Basically, everything that trades against the dollar was kind of bullish, because the market reacted directly off that as well, because what you find in most cases, because it's of a lower CPI reading, investors tend to think, not the lower CPI, but higher CPI reading tend to mean that you can expect the dollar index to increase in value. But like you guys know by now, the market obviously needs liquidity, and you cannot just expect the market to basically, just take off, from where it is there. So you can see that the market basically reacted quite, came through, took the news quite positive for that duration when it came out. And if you look at the dollar index, for instance, over here, if you go on the dollar index on a 1 hour chart, you can basically see what the market had done over here. We had that massive liquidity spike. However, I do still anticipate the dollar index to continue lower. Now, why you might sit there and think, okay, but why do you expect the dollar to go lower if you say that your CPI is going up? But that's because you guys must understand that the market moves in waves, and remember that fundamental data drives the long-term momentum of the market, while technical analysis drives the short-term momentum of the market. In order for this market to continue, let me remove that. In order for this market to continue higher, you can't just expect the market to just go from where it is now and then just jump all the way to the upside. No, the market needs the liquidity, and if investors understand which direction the overall market needs to go, then that is exactly what they do. but they will find the good prices to buy it from. And that is where the word price action comes through as well. Now, the best price to buy the index in terms of where we are now would be at this level over here. Why? Because this is the previous level of resistance that is now turned support. The market also printed a massive impulse. So after an impulse, you expect a correction. And if you take your Fibonacci from the low to the high, we can see we got a 61.8 Fibonacci level that's lining up perfectly with that structure. Now, I do expect the market to continue lower straight to where it is now. One thing to keep in mind is that the market is currently trading at this very strong level of support. So if you are a cautious trader like myself, right, what I would suggest you wait for is a clear break below this level. On the retest, you can expect that continuation to the upside. Alternatively, if this market decides to pull away, then so be it. But I would not want to trade this market to the upside unless I get a clear break out of this structure, because what you can see here basically is you can see how the dollar index was just consolidating this week. So we had the market came into that consolidation phase and the market was basically trading sideways, and we had the news today. I do expect the market to go higher, but for now we need liquidity to move first. Guys, that is it from my side. Give me your thoughts in the comment section below. Let me know if you traded the CPI. Was it a buy? Was it a sell? 1 minute strategy? Please let me know what you guys' thoughts are. And that's all from my side. Thank you for your time. And as always, cheers for years.